Welcome to The Explainer. Today, we're putting on our equity analyst hats and tearing down literally one of the most fascinating financial stories of our lifetime. We are looking at how a consumer staple company, a beverage maker of all things, managed to completely crush the hottest tech stocks over the last quarter century. We're talking about Monster Beverage Corporation. And let me tell you, the actual financial mechanics behind how they created this much generational wealth, it's just mind-blowing. Let's get right into it. Here's our roadmap for today's explainer. 1. The quarter-century compounder. 2. The asset-light profit engine. 3. The Coca-Cola distribution moat. 4. Stock splits and liquidity. 5. Share buybacks and EPS. And finally, 6. The Q1 2026 valuation reality. Section 1. The quarter-century compounder. 226,856%. I know, it sounds like a typo, right? But that staggering figure represents the actual total return of Monster Beverage over the 25 years ending in April 2026. This performance officially makes it the #1 top-performing stock in the Russell 1000 over that exact time frame. We're talking about an annualized return of roughly 36.3%, which just massively outperforms the historical average of the broader market. To put those wild percentages into some absolute perspective, imagine this. A $10,000 investment in Monster back in early 2001 transformed into roughly $22.7 million by mid-2026. Seriously, think about that. A consumer staple and energy drink completely eclipsed the massive tech titans. It beat out Apple's $7.1 million and Nvidia's $6.2 million over the same period. It's an absolute testament to the power of finding early-stage valuation and just letting that sustained compounding run. Section 2. The asset-light profit engine. Now, how do they actually do it? The secret sauce here is their asset-light business model. Unlike traditional beverage giants that own these massive, capital-intensive bottling plants and huge logistics fleets, Monster essentially outsources almost all of its manufacturing to third-party partners. This keeps their capital expenditures incredibly low. It allows them to focus all their energy and all their cash on what they actually do best: marketing, brand development, and cultivating that edgy, extreme sports lifestyle identity. And the absolute superiority of this outsourced model shows up right in the margins. Monster operates with a net margin of over 23%. Just compare that to a mature giant like PepsiCo, sitting around 9%, or a newer competitor like Celsius at under 6%. Because Monster keeps its balance sheet clean of heavy fixed assets, they maintain an exceptionally high return on invested capital. We're talking around 24% in fiscal 2024. That is massive. When we do an operational deep dive, we see their revenue concentration is heavily skewed toward their core high-margin product. Over 92% of their revenue comes straight from the Monster energy drink segment. Now sure, they are trying to diversify a bit into alcohol and some strategic brands, but make no mistake, their incredible operational leverage comes from this intense laser focus on a single, highly profitable category. Okay, here is a number that equity analysts literally dream about. 0. Nada. This represents Monster's long-term debt. Entering 2024, the company reported 0 long-term loans, which means absolutely 0 interest expense. This conservative financial management is a huge competitive advantage, especially when we go through periods of rising interest rates, because their unlevered free cash flow is perfectly protected from the drag of debt servicing costs. Section 3. The Coca-Cola distribution moat. So back in 2015, Monster and Coca-Cola engaged in what I consider a brilliant, highly functional asset swap. Coca-Cola basically handed over its global energy brands, things like NOS and Full Throttle, to Monster. In return, Monster gave Coca-Cola its non-energy portfolio, your natural juices, your sodas. This was a win-win that allowed each company to strip away distractions and focus purely on their core competencies. But here's the crucial point. This wasn't just a simple brand swap. Coca-Cola actually bought a 16.7% equity stake, and more importantly, Monster plugged directly into Coca-Cola's unparalleled global distribution network across more than 200 countries. This partnership essentially created an outsourced global monopoly for distribution. It reduced Monster's distribution spend by roughly 15% compared to peers, and as of Q1 2026, it is the exact reason a massive 45% of their total net sales are now generated in international markets. Section 4. Stock splits and liquidity. Now, You really can't have a stock appreciate by over 200,000% without the share price becoming mathematically unapproachable for everyday retail investors. So, while stock splits obviously don't change the intrinsic value or the market cap of the underlying company, mapping out this timeline shows just how proactive management has been. From 2005 through 2023, they executed 5 major stock splits. And the cumulative effect of all this financial engineering is a staggering 96-to-1 ratio. Meaning, if you had bought just one single share prior to August 2005, you would be holding 96 shares today. This kind of share proliferation is the absolute hallmark of a company experiencing multiple orders of magnitude of growth. It's how they ensure the stock remains psychologically accessible and highly liquid on the open market.
Section 5. Share buybacks and EPS growths.
Monster Beverage has historically avoided paying out a regular cash dividend. Instead, they opt to engineer shareholder returns through incredibly aggressive share buybacks. So here's the step-by-step cycle of how this works. Step 1. Their asset-light model throws off a massive amount of free cash flow, like $3.7 billion in 2024 alone. Step 2. They use that cash to repurchase their own stock, like that huge $3 billion Dutch auction they ran. Step 3. This naturally shrinks the total number of outstanding shares on the market. Step 4. Because their net income is now divided by fewer shares, the earnings per share, or EPS, is artificially amplified. It is a brilliant, highly tax-efficient way to continuously compound shareholder wealth. And the thing is, this isn't just some historical strategy. They are actively doing it right now. Pulling straight from their Q1 2026 filings, Monster repurchased another 1.4 million shares for roughly $100 million, and they still have about $400 million authorized for future buybacks. This continuous buying pressure doesn't just boost EPS, it literally proves management's absolute confidence in their own ongoing intrinsic valuation. Section 6, the Q1 2026 valuation reality. When we look at the latest Q1 2026 data, we can see the engine is running hotter than ever. Net sales jumped nearly 27% to over $2.3 billion. Operating income, net income, and EPS all grew at roughly 28% year over year. This completely validates that their core asset-light cash flow engine, supercharged by that massive international expansion, remains entirely intact. But as analysts, we do have to highlight this slight margin compression here. Gross profit margins actually slipped a bit, going from 56.5% down to 55%. The filings tell us exactly why this happened: higher aluminum can costs, increased freight and logistics, and a geographical mix shift since more sales are originating internationally, which usually carries slightly lower margins. Now, they did raise prices to try and offset this, but it's absolutely a key risk factor we have to monitor closely when projecting out our terminal growth assumptions. In early 2026, Monster was trading at a forward price-to-earnings ratio of around 33 times. Now, let's be real, that is a premium multiple. The market is willingly assigning this premium price tag because of their incredibly durable distribution moat, that zero-debt balance sheet, which vastly lowers their cost of capital, and their dependably high returns on invested capital. But look, at 33 times forward earnings, the market is essentially pricing in perfection. There's a quote from the research that perfectly summarizes our deep dive today. It says, "For the long-term institutional investor, Monster Beverage stands as a definitive testament to the power of sustained compounding." And it's so true. Monster didn't just invent a great-tasting product. They engineered a relentless financial compounding machine. They combined an asset-light framework, a globally outsourced supply chain, and aggressive capital reduction to completely dominate the beverage landscape. So, I'll leave you with this final thought to ponder as you review your own portfolio and terminal growth assumptions. Yes, they have absolutely crushed tech stocks for a quarter century through brilliant operational execution and capital engineering. But at a 33x forward multiple, and with those crucial input costs like aluminum rising, is Monster's premium valuation truly justified for the next decade of growth? Thank you for joining me on this explainer, and keep questioning the data.